One of the concepts we will use a lot this semester is cash flow diagrams. It's very simple but it's very important. It's a way of visualizing the money turnover or the money flow, the cash flow into your company, into the system. Okay, it has, let me show you it because that's the best way to show what is a cash flow. What you see here is a cash flow. This horizontal line that you see shows the time. This vertical arrow that you see shows you the money. Bigger it is, longer it is, more is the money. If it is upward, it means benefit, the money that you receive. And if it is negative, it is downward, it means it is the money you paid. So here, when we want to check things, okay, at time 0 here, positive 100, you get $100. Time period of today, one time period from today, sorry. Downward 100, 200, so pay, receive, pay, receive a small amount. So it is a cash flow, and it is something that you need to learn, but that's it. So whenever you want to draw the cash flow, you go with a horizontal line and you go all the payment times. For example, when you are checking your mortgage, if it is 30-year mortgage, one of the things that happens every month, so 360 downward arrow, because all of them are payment, and the money you get at the time of 0, at the closing time, it is a big amount over there. So you see, you are learning to model things in the field of finance. Here I have an activity for you. So it is asking you to draw a cash flow with a spreadsheet, but a spreadsheet, put it for later, when you learn better about all the things. But I suggest, after you learn the basics of cash flow, that is nothing, also very simple, try to do it with a spreadsheet, as I'm gonna show you the answer with the spreadsheet. So for this one that you see, just draw the cash flow. We have the capital costs. It happens 2 times at the year 0 and 6. So most probably it is the salvage cost that we have. That is because you are selling the things, it's going to be positive. And after that you have here. So stop the video and try to draw the cash flow. And just for example, in this case, that you have 2 costs. So on that year, at year 3, the cost out of pocket would be 37,000. That you can do it, for example, in this way, to this way. Okay, stop the video. I'm about to show the cash flow diagram. And here you can see the cash flow. We have 6 years, 0, 1, 2, 3, 4, 5, and 6. And year 0, as you can see, scaled, $80,000 cost. Year 1, 2, 3, 4, 5, 6. We all have this recurring installment. And 3, 2. So you see, It is a cash flow and it shows everything, and it's way easier to read and understand in comparison to tables or text. Let's make our calculations more computational, more technical. About the cash flow. Now you know what is cash flow and you know how to draw it. Would you rather receiving $1,000 today or receiving $1,000 10 years from today? Of course, your answer would be today. Why? You can tell me 10 more bullet point here, but here I have put 3 for you. You can invest 1,000 today and you make money during these 10 years. Okay? You can buy many things today that they would be way more expensive in 10 years, or even you just want to get things now. Who knows what will happen in 10 years? And you can put many. So, long story short, my friend, we have this undeniable concept, time value of money. If someone asks you, is $50 a big amount? You shouldn't jump immediately, say yes or no. You should ask when. $50 100 years ago or $50 now? Because money has a very important attribute, that is time. And that's a very strong player in the decision makings of a financial manager. And of course, yes, 99.99% of the situation, money now is worth more than money later. I'm not talking about the very specific situation that money grows in value. Generally, money now has higher value, and here you can see money is more valuable today than in the future. That's a fact. We are not talking about the exceptions. Let's go do another example together, another activity together. So it is asking you to draw a cash flow diagram for this case. You purchase a new $30,000 machine. You have this cost that is on a yearly basis, and the savings happens year 1, 2, 3, 4, 5, because you are buying a machine. So it is the terms that you are going to get used to. When it says savings, it means that the savings or the money the machine brings you. Okay, so you have costs for the life of the machine. You have this savings, income, earnings, and also the salvage value at year 5. So draw the cash flow diagram. Stop the video, draw it before I show you the answer. And also you should learn also to document the information on the cases that are provided to you in a table. Because again, it's about way of thinking, and all the things or make your brain structured more and more for making the decisions on a more clear context. I'm about to show the answer. Ready? Here we go. And here is the table. And here is the cash flow. All the revenues, savings, all the costs, the salvage value, everything over there, and you can get, and so you can start doing the analysis, computation of analysis, that we'll start working on those topics soon. About the time value of money, here in this slide, you are gonna see again a witty, business-based, business-minded definition. Like the definition we had for insurance, here also we had that type of thing. And it says why time value is that much important. Apart from the examples that we said in the previous slides, here it says that because money can be leased or rented. So that interest rate is in fact the cost of renting money, is the cost of leasing money. So it's that witty way of defining interest, and that payment is the interest. Now let's go with an example. If you put $100 in a bank, so bank is renting money from you, $100 at 5% interest for one time period. It can be 1 month, it can be 1 year, it can be 1 quarter, anything. But we know that they pay you 5% at the end of one time period. How much you will receive back? You will receive 5% interest. So it means that you give them at the beginning of the period $100, and at the end of the period you receive 105, because they pay you also $5 in interest. And here is the details of the calculation. Interest to be returned, $100 times 0.05. So the original amount of money plus the interest is the total amount that you get. Please, my friend, try to master all the things as much as possible and grow your foundation in this course as strong as possible. Even if it seems to you simple now, it can get complicated. So please reflect, check, ask, exercise, so all the things becomes part of your second instinct. Okay, let's do an activity together here. And when it says simple interest, simple interest means that there is no interest over interest. You just get interest on the original initial amount of money that you have invested. Okay, so simple interest. Loan of $5,000 for 5 years at simple interest. So it means that you are not gonna get interest over the interest of your money, because when you put this $5,000, of course after 1 year you get interest. At the end of year 2 you get interest, but you are not gonna get interest over I1. So it is asking you for loan of $5,000 after 5 years at simple interest of 8%. How much do you have at the end of year 5? stop your video and start working on that. Do the math, check the previous part of the slides video if you have any questions, and try to get the answer. I'm about to show the answer. Ready? Here is the answer. We have put $5,000. 8% is the interest rate, and it happens for 5 years. So the total amount of interest is $2,000. And at the beginning we put $5,000 and we get $2,000 in interest, and totally we get $5,000. But some part doesn't make sense. I agree with you, because you are thinking about, for example, that $400, because $5,000, 8% is $400. So for the first year, and you are thinking this $400 at the end of year 1, so it waits idle year 2, year 3, 4, and 5. So now, in fact, your brilliant mind is guiding you to the concept of compound interest. The type of interest that you get interest on the interest.